Welcome to PACE Moments. Here, our experts and guests discuss many aspects of corporate finance and analytical models that will help make better, more informed business decisions possible in your organization.
I'm Doug Hicks, one of the directors of PACE. One of the topics they never seem to cover in an accounting curriculum is the history of the ideas being taught. Whether it's Josiah Wedgwood inventing cost accounting to analyze and assign overhead costs in response to a drop in demand and rising costs during the 1772 recession in Europe, or Albert Fink using the causality principle to measure the costs per ton mile for railroads in 1860. Universities exclude the rich history of accounting and the thought processes that resulted in the practices from the education of aspiring accountants. This omission makes accounting a bunch of rules, regulations, and methodologies that are memorized but seldom fully understood. As a result, practicing accountants tend to apply what they've learned in ways that often do not reflect the economics of the phenomena they're trying to measure. In short, they misapply their knowledge because they understand the how, but not the why. John Maurice Clark was a managerial economist who noted these problems a century ago and addressed them in his 1923 book, Studies in the Economics of Overhead Costs. A few quotes from that book address issues that are problems still today. One of those issues is the nature of direct labor. On that topic, he stated, "Yet the substitution of machine for hand labor meant nothing less than the introduction of a new species of creature, which rapidly became the dominant personality in industry, especially in the actual physical work of manufacture and transportation. Formerly, the laborer was the central figure. He worked according to the laws of his being, and his tools worked as he required their services. Now the machine is the central figure, and labor follows the laws of the machine's being and works as it requires his services." Later on, he added, "The fact that human labor comes to be more and more a matter of overseeing and guiding the iron slave, the laborer has in fact become a supervisor, but the work of supervision is commonly spoken of as an overhead cost." He also addressed definitions of fixed and variable. He said, "Engaging the effect of added business on cost, it makes a great difference whether we are considering a long-run or a short-run policy. The wages and salaries of the indispensable nucleus of the force are sunk costs which practically cannot be avoided with reference to a short period. But with reference to a long period, they would be variable cost. Evidently, time alters the definition of cost. In fact, the way in which costs behave in response to a 20% increase in business is one thing if we have to deal with a 20% increase in the output of a current month or 3 months, and a very different thing if we're talking about a permanent increase of 20% in the total business, so that our ups and downs, our good years and our bad years, would all be on a scale 20% larger than before." A little later, he added, "No one formula could be made by an accountant which would distinguish between constant and variable expense in such a fashion that it could be used to get the correct solution to every one of these different problems." Perhaps one of his most well-known observations was on the need for different costs for different purposes, a subject he touched on 3 times. First, most of this controversy will disappear if we carry our study far enough to recognize that there are different kinds of problems for which we need information about costs, and that the particular information we need differs from one problem to another. Then he added, "We may start with the general proposition that the terminology of cost is in a state of much confusion, and that it is impossible to solve this confusion by discovering and adopting the one correct usage, because there is no one correct usage being governed by the varying needs of varying business situations and problems." And finally, he concluded, "As a result, if cost accounting set out determined to discover what the cost of everything is, and convinced in advance that there is one figure that can be found which will furnish exactly the information which is desired for every possible purpose, it will necessarily fail, because there is no such figure. He also addressed the failure to adequately measure selling costs by saying, if economics has paid insufficient attention to overhead cost of production, it has definitely ignored the cost and services of selling goods in formulating the formal laws of value. Finally, he emphasized the fact that in costing, there is no one simple answer by concluding, to be more specific, the problems of overhead costs are, above all else, not foolproof. The student cannot be given a formula which will furnish an absolute answer to every question. He must use the highest grade of discriminating judgment if he is to distinguish case from case and to determine which rule applies or which policy is the most promising of results. The parrot which has been trained to repeat supply and demand can no longer qualify as a competent economist, nor even a fair caricature. All of these quotes from this 1923 book reflect issues that still need to be addressed today. The rules and regulations of financial accounting are man-made laws that must be followed in reporting historical results to parties outside of the organization. They can be taught as givens, memorized, and followed literally. Management accounting, accounting designed to support the decision-making needs of internal management, has only one rule. That rule, reflect economic reality. There are no man-made laws that it must follow. It is guided by the laws of nature. Such a fundamental difference at the core of the two disciplines suggests that in education and management accounting requires an entirely different approach than in education and financial accounting. Where financial accounting can require the memorization of rules, regulations, and the techniques for applying them, management accounting needs to emphasize the ability to evaluate specific situations, model those situations following the principle of causality, understand how to measure economic costs as they relate to those specific situations, and then apply the tools and techniques that have been developed to measure those situations effectively. John Maurice Clark realized this a century ago. Why, 100 years later, don't we appear to understand it today? Perhaps a new approach to teaching management accounting would lead management accountants to use the powerful process of thought to arrive at better solutions to the challenges that face them in the 21st century economy. That's my point of view. What's yours? Let us know by posting your comments on LinkedIn or in the PACE website's forum. We'd love to hear from you. Thank you, and I hope to talk with you again soon.
Thank you for listening to our PACE Moments podcast. To learn more about profitability analytics, check out the PACE website, join one of PACE's interest groups, and follow PACE on LinkedIn and Twitter. Thank you.